What's up, guys? We're live with the KIO macro. We're going to try to do this one a little shorter here. We don't have Sir Isaac the Schick Newton, just me and Jay Tuda. And we're going to be going over financial markets, crypto, stocks, maybe some bonds. You know, the market's kind of, at least the crypto market's kind of taking a breather right now. So we'll let you guys know our perspective as we bust open these charts. JT, what you...
Real quick,
I'll get into the charts, man.
After you go over through the charts really quick, we'll break down the CPI report. Interesting CPI report today. So, yeah, it's going to be some good stuff.
Sounds good. All right. Starting from the top down, we got the central bank balance sheet. I want to start seeing this 200-day get above the actual line that's coming down here. We've been at this spot for, I think it looks like it's starting to peek through a little bit, actually. I know you guys can't see it, but I can. So hopefully that trend continues.
Well, it's definitely going to continue. They still have about 4.8 trillion bonds. And so they have to get them off their books. The Fed doesn't buy junk bonds. Junk bonds are non-investment grade corporate bonds. There are no junk treasury bonds, I would say. They just bought. And I explained this in like 3 of my videos. The one I'm getting ready to post is in that one as well. But essentially, most of the bonds that they bought over the last decade are yielding them about, let's say, 4% or less. But they're paying out the Fed funds rate to bank reserves. And so they're paying out 5%, generating 4% on the largest asset holdings that they have on their balance sheet. They're literally operating at a loss. They're not losing money, but they're operating at a loss.
Okay. All right. Now let's take a look at this M2 money supply. We still have this kind of consolidating. Why do you think this is consolidating right now and not going down?
To be honest, just because I think there was like somewhat of a slowdown in the balance sheet runoff. Because the balance sheet runoff, I think, is going to be probably the biggest factor in terms of pulling liquidity out of the market. And so the M2 money supply should start to fall if we see like an accelerated runoff, which I don't think we would see. I just think they're tapering off the assets off the balance sheets versus just like fire selling them. Because some of them, obviously, they also have to wait until those assets mature as well. And so there's some lagging effect there. And so, multitude of reasons. But primarily, you can basically look at it as just the balance sheet runoff. And so probably there's a smaller amount of assets that are maturing during this time frame. But obviously that's going to shift probably April and then another one in like June. And so, yeah, it's definitely going to keep falling. So that's just what I think. We're always printing money somewhere else just because of the fiscal side as well. We got to continue to finance the deficit. And it's one of our largest expenses. But yeah, I know we're probably going to get into that at some point in this episode, though.
I was planning on just avoiding that altogether. So, no,
okay, it makes sense. I hate that shit. But no.
All right, look at gold. Not even going to waste our time because it's doing the same shit. And we'll probably still continue to do the same shit.
Why do you think gold is like just for what all the gold bugs say about the gold price? Why do you think the price action just sucks? Is it all based on manipulation or what is it?
I think that, and I'm not trying to sound like, Michael Saylor here, but
because you can't take it to London from Canada.
No, it's like, man, it has the gold ETFs made it easier to be able to manipulate
because of the paper aspect.
Yeah, I feel like that's the biggest thing. Like there isn't
I would agree with that.
There isn't people talk about Bitcoin versus gold. Like Bitcoin it's an asset, it's a network and also a protocol. So it's like you can sync up all the Bitcoin in the world through like some underlying payment service device like Square or PayPal, and it can like be all synchronized with integrity, and who owns what Bitcoin, when and where. Well, not necessarily where, just in regards to the keys. You'll know what the keys are, the wallet address that holds them. You can't really do like the same kind of like fractional reserve banking as like there's no way to sync up all the paper gold and the actual gold in the vaults and have like the prices updated in real time, like it's physically impossible. And given that these banks have all this gold in their vaults, they can like 100x short it because they know people aren't going to come get it. And then like whenever the price does start to go up by any kind of factor, people are going to like go recycle their gold, like take it, their necklaces, their lamps, whatever. And I feel like the fact that gold is actually tangible is actually probably its biggest downfall. When people look at that as like, oh, it's tangible, you can hold it. People have a hard time like quantifying value to a piece of software, but our lives are becoming increasingly digital in all aspects. So it's only right that our stored value does too, in my opinion.
Good point. That's a good point, man. That's a great point.
Yeah. So there's a gold lesson for today. So now let's look at the S&P. So we saw let me go down to the weekly, see how big this rally really was. So in the past 3 weeks or so, we saw the S&P rise like a good pretty much 8.5%. I can't make any crazy calls until it gets outside of this channel and like breaks and retests to the up or the downside. We got out of it here for a bit, and it looked like we were going to come and break and retest the downside, but we got a green candle, and now we're back in the channel. So we're still trending upward. Yeah, which is crazy.
And it's crazy because when you think about bonds versus equities or stocks, there should be some type of like negative correlation.
Yeah,
and
like yields are risk off, but it's not showing it.
So this is why I think this will start to change. This is part of the reason. So when you look at bond yields, they've actually been pulling back, the last 2 days or so. And that's been kind of reflected in the stock market. But it's also because the reason yields have been rising so much is because demand for bonds has been falling through auctions, and also there's more supply because the Federal Reserve, once again, offloading the balance sheet of all the bonds. And so eventually, and like one of the things that I think will happen is that you will start to see more demand for bonds as yields continue to the upside. And so you'll start to, specifically short-term bonds, because it doesn't really make sense to lock in a 10-year even for me right now, or a 30-year, especially if you believe that bond yields are going to move higher, which means your bonds that you're holding are going to be worth less. And so there should be demand to the point where yields start to fall and money starts to flow back into the long end of the curve, and also the stock market, which will shoot the stock market back up. But we haven't seen that yet. And so that's why I still think there's more, even though these past couple of weeks have been abnormal, there's more downside in the stock market because the yields on bonds will continue to be more attractive. We saw a slight pullback, whatever. And inflation's down too. Inflation's the CPI report, which we're going to get to, that kind of like anchored that thought for me. So inflation came down, and so now you'll probably start to see more demand for bonds, especially if people think the Fed has over tightened, which there's a pretty nice camp of those folks. And so they're expecting some downside, but once we get through that, equities are gonna be in another crazy bull run, man, because I think we figured out like master stimulus for like the next at least 50 years in the US of living, in terms of the US dollar living.
Yeah, and with like the whole digital dollar thing, being able to like spread the dollar out more, that gives us more room for fucking up, to be honest.
Yeah.
Man, quick question. I just thought about something. Like when it comes to the Fed buying bonds, because correct me if I'm wrong, I don't think they would be buying it to make money. Probably
no, they buy it to, it's a form of QE. So when you look at it like this, so when they buy bonds, they pay you for those bonds. And so if you're a bank, you have liquidity now to use for whatever.
Oh, they buy the bonds that the banks were holding.
Yeah, the banks they can't buy directly. They can't buy directly from the treasury, and so they use investment banks and other special purpose vehicles for that.
And they don't really, as long as they're not junk bonds, obviously, because we talked about that, they don't really give a fuck what kind of bonds they are.
No, they do. Only U.S. Treasuries, and the reason they buy U.S. Treasuries is because the default risk is null.
So they only buy government bonds, no matter the term.
Yeah.
Okay.
And so that's why if you guys ever hear monetizing the debt or debt monetization, that's what that is. And it also included in that debt monetization basket is mortgage-backed securities. It's just kind of a relatively small holding relative to bonds, but it's still pretty large.
So you can think of monetizing the debt as like securitizing it and giving it value so it can be traded.
Well,
Monetized.
there's already securities. So you can look at it like this. So if I'm an investment bank, right, and I buy a bond that yields 2% or less, which most banks did over the last decade. Now, interest rates start to rise. The yields on those bonds are now 5%, double at the yield I'm getting, which means the value of my bond is worth so much less. What am I going to do? That's an unrealized loss. And so now I'm pretty basically fucked once those securities or bonds mature. And so the Fed, being the backstop that it is, the Fed comes in and they say, hey, how about this, man? You got 500 billion worth of bonds that are unrealized losses on your balance sheet. Let me go ahead and buy them from you. I'll give you the 500 billion. I'll take it off your hand. Of course, I can take on that risk. I'm the Federal Reserve. And I'll take those bonds off your books. And now that shores up the banking system and basically sends the debt to somewhere where when it explodes, it's like a controlled explosion and like it's in a room, boom. And so it doesn't affect anyone type deal. And the Fed now they can't hold these assets on their books forever. And so now they're in a position to where they have to actually get rid of them because they're going to mature. And they're not going to reinvest in those bonds. So they're going to come off. And so now you have to have buyers for those bonds. And that's where the current problem comes in that if you don't have an adequate demand for bond auctions, you get more institutions, dealers just buying those bonds back, which we've seen an uptick in the last two. And you see less foreign demand. And our largest holders is China and Japan. And that dropped from 68% down to 60% just in between one auction. And so that's a 7% decline or whatever. So yeah, man, I forgot what question you asked, but I hope that answered it. I just went through a lot there.
Yeah, no, I was just asking like their criteria for buying bonds. Man, speaking of China, the president of China is in town here in San Francisco.
Yeah.
Bro, they cleaned up the whole city, and I don't know where they put these homeless people. They're gone.
Oh, fuck. Nobody's talking about that, huh?
No, they're talking about it all online.
Probably only in San Fran. Shit, I ain't seen it nowhere.
Yes, definitely not in like mainstream media, but bro, it's like walls in certain part of downtown. They got all rid of
they lying, bro.
And they put like flower things, like they made it all nice. Like,
damn,
bro,
President Xi probably like, whoa, this is nice.
Yeah, like, oh, these nice, dude. Keep real clean, no homeless. Like, nah.
Oh man.
Oh man. Hey, we love Chinese people, by the way.
I really do. I basically, when I lived in the Bay Area, every roommate I had was Chinese, literally, and that's like I had dim sum guys. I had chicken feet. Okay,
chicken feet. I thought that was a black thing, but all right.
Chicken feet, bro. When the hell have you ever heard some black people say they about to get some chicken feet?
I guess that's pig feet, huh?
Yeah, no, chicken feet barely got meat on it. I still have the photo from when I ate it. It looked just like a real chicken foot that I ate. Yeah, it's actually pretty good. Just kind of like a snack. It wasn't very filling.
Anyway, all right. So we talked about the S&P.
I also had chicken balls too. No, I'm just playing. Go ahead. Oh man,
what is wrong with you, bro?
All right, let's get it.
All right,
guys.
So yeah, here we are on the Dow. until we like break out of this channel we're in, we're kind of just still consolidating, right? Like we're right on top of the 62 and the 200-day. We've been in this box pretty much since like February 2021. Yeah, we came out of it for a bit, but we never really broke this trend line, and we never got to this trend line either. So few levels that we need to go before stuff is like, I don't know, return to the mean, but it seems like we're raising the mean out here with how we're doing things.
Yeah,
But
same thought for me on all major indices that you're showing here, S&P, Dow, and Nasdaq. They will all be affected by what we just talked about before with the bond market.
yep.
I think, at least. I could be super wrong because, hey, things have been different this time, damn it. So,
Man, good question. We're looking at the Apple chart here. It's still hovering around like previous all-time high levels.
Uh-huh.
Right on top of our 62 and our 200. Does this might be a stupid question. Maybe someone in the audience is thinking this too. Does companies like Apple and Amazon, do they issue corporate bonds, or public companies can't issue
Wow, I
corporate
can't
bonds?
believe you would disrespect our audience and say they're probably thinking this dumbass question.
Is it really dumb?
No, it's not dumb though, but yes, yes, they do. They issue corporate bonds. They do.
Apple
Uh,
does?
they do, but they're not. They don't need it because they got a lot of cash. But to answer your question, they have done it before. I don't know if they're actively doing it now. They're probably not, but they have done it before. But they've always been super cash heavy, so it's not reliant. Some corporations, they rely on issuing corporate bonds to service their own debt, aka zombie company.
Do you
Huh?
know like
No,
major
man. And that
corporate bonds?
I should next time we do this, I'll have some prepared actually. That'd be good to go through them. But the number is, I was looking at a report of the number of zombie companies. Is actually on, they referenced this report on CNBC, I should say. And the number was like there could be as much as 20% of corporations are zombie companies. 15 to 20%. And that's a pretty crazy number. That number has only
In
gotten
general
worse.
or on any indexes?
S&P, I believe it was.
Wow.
And you know, that will make sense because of the interest rate hike cycle that we just went on, because they hold government debt. And so for them to pay off a lot of the debt that they own, they have to issue corporate bonds to buyers. And so they have to borrow money to pay off borrowed money. So
It's actually pretty crazy. Yeah, guys, it's two ways to raise capital: equity or debt. Equity, you give up like equity in the company. This is what companies do when they go public or when they raise like VC. They give up a percentage of the company. When you go public, you carve off a percentage of the company, you allow it to be sold on exchanges. Debt, you pretty much.
So I guess there's been like a more in a general sense, yes, but also there's been this uptrend in private credit. And so it's not quite taking equity and it's not quite a full loan. And so there are some perks and benefits to that as well. It's grown to like $2 trillion or something like that over the past like year. And that's because it's been harder to get financing at a normal bank. And so a lot of people have been doing and offering private credit. So you got private equity or equity investments. You got, like you mentioned, offering debt, and then you have private credit, which is like credit lines and stuff.
Got you.
No.
Okay. So we looked at, the stocks here. Let's look at crypto. Look, one of the hardest things to do as a trader or investor, especially if you look at charts, is to like look at the chart without preconceived notions and without seeing what you want to see or what you think you want to see, if that makes sense. So it's like, I'm looking at this Bitcoin chart, and like for me to confirm getting into a trade, I look for a couple confirmations. You have to check at least like 2 of these boxes for me. 3, actually. I want to be above the 62 EMA or the 200-day. The more important one is the 62, as you can see. Like there's been times where like right here, the market was going up, but it didn't get over the 200-day until like right here, and you would have missed out on these profits. But pretty much when the market's like on top of our 62, which is this orange line, which is like rolling Fibonacci, which is like, language of the universe. That's like a whole nother thing. Look up Fibonacci. Most of the time when the market was on top of this, we were in a bull market. Most of the time when it was under, we were in a bear market. So I'm seeing us on top of the 62 and the 200. That's one confirmation. And then the next confirmation would be, well, this is the first confirmation. I want to be above like an important resistance level for a long, and below or above an important support level or previous resistance level on a long, and below a previous resistance level, support level for a short. So that's 3. So the $35,000 level we broke and we retested it. And this is the weekly, right? We broke it. We retested it with this green candle. And what I look for in a confirmation is like, I want to see a nice big green candle print, because that'll kind of signal that volume is up. Volume has been down a lot though. Like, as you can see, let me move this out the way. If you guys look down here, you see like the line is pretty much right here. But as we got into the bull market, we saw the line was above where this dotted line is. So I do look at volume as an indicator as well. But the next confirmation will be to break and retest my trend line. So it broke a top of this blue trend line and it's trying to retest it. So it's like, I'm trying to look at this and go, I do kind of factor in, or not kind of, I do put heavy weight on the fundamentals as well. A lot of people will say the fundamentals are reflected in the chart. Well, this is like a first time thing where we have an ETF getting approved for a brand new asset that's never existed, for a brand new asset class that's never existed. We see what the ETF did for gold. We talked about that last week. So yeah, I don't know what's going to happen. Like, the ETF gets approved. I still think we have a recession, but this chart looks bullish to me, and I can't deny that. But macro fundamentals are bearish and bullish at the same time. Short-term bullish, mid-term, I don't know, long-term bullish, if that makes sense.
Yeah, man. I would just like to add real quick too. I know you don't have the RSI pulled up on your screen share here, but it is at 70. It did hit 70 on the weekly chart, and so that means it's overbought. So it's in an overbought scenario, and so short term, and this is kind of what I would think. Like, short term, I know you just said you're bullish. I would actually be bearish short term, just because it's like one of those things. I still think we're in that phase of buy the rumor and the news will sell. But once the news is solidified, we'll see that real bullish or parabolic move, whether it's slow or fast, that everybody's been talking about. We'll see that once the ETF is actually in effect. Because I'm really in the camp that I think they're going to approve more than one.
Yeah.
At the same time, I think so, man. Like if you see Kathy Wood, she glowing. Kathy Wood only glows when something good about to happen to her. Other times she just be normal, but she's been glowing, man, and she's been getting like good feedback or something. Like, something's going well, because she's one of the applicants for a spot ETF. So that's what I would think. And I like to use this relative strength index, the RSI, just because, I don't know, for me, I'm not really a trader, but it has been pretty good to me over the years. So I would be bullish short term.
Okay. No, that's a good point. I'm also thinking about the halving, man. Like, more so from a narrative standpoint, less so of a supply and demand standpoint. Narratives drive bull markets a lot of time. Like, we saw that with NFTs, we saw that with DeFi, we saw that with layer twos. And I think we're going to see that with real world assets and real yield protocols here in this next bull market.
That's going to be the wave, I think.
I think so too. But yeah,
with the halving. Oh, my bad if you weren't done.
I was going to say, these are like, this is what I'm thinking. I don't know what's going to happen. I'm just going to go off my confirmations and act from my rules from the plan that I created. And,
which is the best way to do it. I mean,
management, I should be fine.
Yeah. In a way, guys, when we talk about this shit, it's kind of like it provides some fulfillment and satisfaction as well. But at the end of the day, you wouldn't be like, say if you were bullish on Bitcoin but weren't an expert, it wouldn't hurt to just DCA in for as long as you can. Eventually, all the gains will average out. And it's been proven that, like, if you miss like the 6 best days in the S&P over a decade, you lost like 50% of the gains.
I think it's more,
actually. Probably, but it's some high number. It's crazy. And so it's good to just stay invested as much as you can. Yeah, you can have some fun trading and make some extra money if you know what you're doing there. But yeah, it wouldn't hurt to just dollar cost average in.
Yep. All right. So if we look at ETH, same thing. Not as bullish. Well, you heard
the ETH ETF. Have you heard?
Yeah, that's literally about to actually BlackRock filed an ETH ETF. So it's
bro,
like,
they crazy, bro. Next is Litecoin. Shit. Like, no, but but no, man.
I wouldn't be surprised,
that's
man.
Crazy,
Litecoin,
bro. I'm not gonna lie, bro. I would be more bullish on an Ethereum ETF than I am on a Bitcoin ETF.
Why?
Well, for one, I think even though ETH had some mechanisms that are inflationary, I still think because it's
inflationary or inflationary?
inflationary.
Okay.
Yeah, I still think that because the utility of ETH and like the world was kind of built on top of ETH, I'm more bullish on it. I think it has more upside.
Definitely has more upside. Okay, so I see what you mean.
Yeah, 100%.
ETH is actually the reason why I wanted to get clarity on the inflationary deflationary thing. It's like they've implemented mechanisms that if people are using the ETH network, it could become deflationary.
Okay, it could become, and that's the
Some
goal.
days it is.
Okay, probably, but most
No,
days
it is on some days. You can see it.
Okay,
on
yeah, it is on some days.
No, it is. My bad. Go ahead.
Man, no, on most days, you know, you got massive amounts of ETH being burned / minted. And so I think there's more ETH being minted than burned. Am I correct in that?
Right now, yeah.
Yeah. So I mean that is devaluation right there.
It was way worse before they went to proof of stake.
I agree, and I know that's been a problem that they've been working on for years. But at this point, it's like until ETH actually accomplishes that thing that they're discussing, it's one of those things I'll see it when I believe it. ETH, you know, they'll have projects in development for 5 years. And like time will go past, we don't even realize it. We're like, damn, it's still not out.
No, seriously.
So yeah, like it, you know, we'll see what happens. But as of now, my current assessment is that even with the inflationary side, which is why I think ETH is not more valuable than it is right now because of the inflationary side. But yeah, even with that, I'm still more bullish. The utility outweighs everything, bro.
Yeah, no,
like,
I agree with
look,
that.
why do you think Taylor Swift is so valuable to the world, like in the music industry? The utility she provides for people, like in the amount of people across demographics, it's kind of unfathomable. You can't put a value on it. And so the lady gonna be a goddamn billionaire over it, you know, just for making music. So that's like one extreme example of how utility can just be invaluable. It really can be.
You know, I finally listened to that one song. Jada played it in the car when we was
What song?
today. It's you.
What song? Taylor Swift?
Yeah.
Oh, I don't know what you're talking about, man.
Like her most famous one, bro. It's you.
I'm gonna be real. Something about it, like you can't get me to just play some Taylor Swift. Like
I won't play it, but Jada
no,
played it.
I know.
I noticed. I was like, it is me. So,
look, Taylor Swift seemed like a nice. It is me. Oh man, she seemed like a nice woman, but that's all.
She avoided the whole FTX bullshit. She didn't take the sponsorship like Steph Curry did.
That's because she don't know what the hell she was doing, and she's smart.
Now her daddy worked on Wall Street, and she got advice from him. Is what she said.
You for real?
Yeah.
Oh damn, that's pretty good. That's probably
it was like a pretty popular financier, like pretty. I'm not gonna say famous, but like known on Wall Street. So that's
wow. That's pretty, man. They got a good little system going there, I bet.
a great fucking system.
Oh my god, that's why she's gonna a big reason why she's gonna be a billionaire, bro. Goodness.
Yeah, no, for sure.
Anyway, enough about Taylor Swift. This is not about Taylor Swift.
I'm a Swiftie. Say no.
Is that a thing? That sounds like a thing.
That's what they call her fans, Swifties.
Wow.
And they're like pretty cult-like. I will say that.
You think I'll get jumped by some Swifties if I was like, oh, Taylor?
If you said it around the right
did it in the group,
bro, they're like, they will send death threats if you say some bullshit about her. That's how
I would assume they're all pansies, but also you never know. It
bro,
could be some big dude like, oh.
Prison inmates, like gang leaders, like Swifties say no.
Man. All right, let's get it.
Going back to ETH, bro. I don't know. Y'all know I've been talking about Radix, but you know they launched the Babylon smart contracts and pretty much turned the blockchain on like a few weeks ago. TVL is at $11 million, and they just had like the top growth by all non-EVM, which stands for Ethereum Virtual Machine compatible blockchains, in 7 days. Bro, they're growing, bro, and they just hit 10,000 wallet downloads. So
I seen your post, or at least a snapshot of it. I didn't click on it. I just looked at my preview on Twitter.
Yep. So But the price is still down. But like we say, market's a short-term voting machine, long-term is a weighing machine. All right, let's go through these so we can get through the. See, this is another thing. Like, man, the market likes to move between ceilings and floors. This could very well come back down, but like we didn't break through this, and we haven't broken through this since February of 2021. But that's why I say I want to see a break, a retest, and I want to see a nice green candle. We already broke now, and we broke it a lot. Like we're above it. We come down and retest and have a green candle. It doesn't mean it's a for sure bull market back on. This is the total crypto market cap, but it's probable that it is. And when you're investing, you want to think in probabilities because that's how you win long term. You gotta be wrong sometimes. And a lot of times the shit that everyone thinks is the way is the opposite. This could be one of those things. So I try to just like sometimes blur out all the noise, look at my chart. I'm not gonna say blur out all the noise because you never want
noise you need.
Yeah, exactly. Like I'm not a day trader, so I can't just ignore all the noise. Like fundamentals does have a huge effect.
And I would say the consensus, to add to that one point there, I would say right now the consensus is that we have entered the bull market.
Yeah, I don't know if I believe that.
And we haven't, but that is the consensus. I've been seeing a lot of bullish content lately across the board.
Yeah, and then a lot of times also like the powers that be, they know that traders are looking at these charts, so they'll try to make something look like something. Like the crypto market isn't hard to manipulate. This isn't happening in the stock market, but the crypto market, few wealthy people can manipulate this market.
Yeah, so, you need liquidity heavy markets are harder to manipulate. Obviously, the markets with less liquidity. And for my crypto people out there, you can look at it like the more liquidity a protocol has, the better the security. So you can look at it like that. Yeah. And then also we're looking at tether dominance, and it's been going down too. And that's important because like once tether dominance is going down, that means people are deploying stable coins and buying crypto. So we are below our 62. So only time will tell. Lastly, let's look at this chain link chart. You can see we were in this zone for May of 22 to September pretty much. And now we're hitting this resistance level right here. So we might come back down, test this as resistance or as support. Who knows? But I don't know, man. It does look like the beginning of a bull market, to be honest with you. But it could just be like a major relief rally, and we're wrong. And that's why I say I'm just waiting on confirmation. And Bitcoin has to like lead that charge. Or it doesn't have to, but it normally does in the past, and I think it will this cycle too. If it's a real bull run, it'll definitely lead that charge because dominance is still at 50%. I actually seen an uptick over like the last 12 months.
Let me pull up that chart actually. Yeah, so this is the Bitcoin dominance chart. It's kind of been trending downward for the past couple of weeks, but
the past 12 months have been not so good.
But for the past year, it's been on this steep uptrend, as you can see. So, yeah.
So yeah, whatever Bitcoin does, and if it's a real move, pretty much most of the market will do that. Of course, you'll have some big losers on those days, but you know, it still has a lot of gravity, man. It still has a lot of gravity.
Yeah, for sure.
All right, so before we wrap it up here, just wanted to go through the CPI report. The CPI report that was just released today. Actually, a lot of people looked at this report as a critical report, as it would essentially determine if the Fed is truly done with hiking rates or not. That's how a lot of people were looking at it, not how I necessarily looked at it. But if you hear that narrative, which you probably would in the next few days or a few weeks, a lot more. Yeah, this kind of solidifies that narrative. So as you can see, over the last 12 months, the blue line is like your headline CPI number. So as you can see, you know,
inflation.
I'm sorry.
Headline inflation.
Yes, headline CPI inflation. So this is consumer price index. So this is your inflation rate that when you see on the news when it's announced. These are the numbers that they're usually referencing when it comes to CPI. So as you can see, the blue line, all items been dropping consistently over the year, obviously with some blips. You see the core more steadily on the downside. And so you could say that the Fed is getting closer to their goals of bringing inflation down, which, as you can see here, they probably are. You can pull up the next one now. Okay, so I got like kind of like the main items circled in this one. And so you can see the number for headline CPI at the top circled in red up there. Yeah, right there with the red. Came out at 3.2. That's down from, I think the last number was 3.7. And then you could see X food and energy, you're looking at 4%. That's the second red circle. You can see that was at 4%, which is down from 4.2%. And I'm sorry, the actual headline is there was actually no change. And you can see that the zero right next to the 3.2 at the top. So there was no change in the overall headline inflation number. Like I said, there was 4% in core. And then once you go services, less energy services. So this was like, you know, your services that you buy on a daily basis that we actually use. Still up 5.5% year over year. And then you can see that shelter number at the bottom in yellow. You're looking at 6.7%. So starting back from the top, headline, whatever, cool. You've seen a drop in energy prices due to mainly fuel, right? So you've seen a drop in energy. So energy is always volatile. So I think, you know, we're being fooled a little bit here because that means we have to believe that energy prices are in a deflationary stage. If you look at those numbers, you can see a negative 21 for fuel and oil. If you could, so that's the drop. So you've actually seen deflation and fuel. And so like, it's just volatile. And so I think obviously we're going to be back to the upside. And so I don't put too much weight on the energy component. And I think this was a large reason we had kind of like a soft CPI report. Core, the change was it's down 2%, basic or 0.2%. So not really much there, but the expectation was 4.3%. And so, you know, a softer number on that regard. And then, so here's the good numbers. The negative 7%, that's the green. Negative 7% for used cars. So you're seeing some relief for the consumer on the consumer side as well. That, I'm not sure if that's going to stick or not, but I would assume that that's probably due to, you know, a lack of demand. So those, they'll probably turn around at some point, but we'll probably see more deflation in the used car sector. So that's actually a good thing. But here's like the big sticking points. And here's why, you know, I think people are overly excited, kind of for no reason. Though that service number, 5.5%. A lot of people are looking at this and they think not that they're saying this, but they think deflation. They say prices are coming down. No, the rate at which prices were going up has slowed. It's slowed to 5%. And so you still have a 5% increase in services that we buy on a daily basis in aggregate every year. And wages are only growing at, you know, 4.5%. And so we're still losing in that regard as the consumer. The shelter number at 6.7%, right under that. That has always been a weird number because they use homeowners equivalent rent, which is not accurate at all. Doesn't make any sense. Why wouldn't you just use real rents, which in some places they have been falling, but in a lot of places they've been rising. So I'd be curious to know what national rents look like on that next data piece when it comes out. And so, yeah, I think people are kind of like excited for no reason. I think the decline in energy that we saw is temporary because we know that energy is volatile. Housing or shelter is still strong, whether you look at the real numbers or homeowners equivalent rent, it's still strong. It's disinflation, not deflation. And services, the shit that we pay for every day, is still going up. Not to mention food was up 3.3%. And so food, once again, the prices aren't going down. The rate at which it was going up has slowed. And so that's disinflation. Deflation is prices coming down. And so I think, you know, you could look at this report and paint a picture that you want to create. And I think that's what a lot of analysts have done. And I think that's what even the Federal Reserve would do. I think they would do the same thing. But also, they just came out the other day. They had a good gauge of where CPI will be. And they came out the other day and say, if you have rate cuts, basically, if you're thinking about rate cuts, it's not grounded in reality. We'll continue to do what we have to do to hit a level in which we are sufficiently restricted, and additional policy firming may be needed. He wouldn't say all those things anticipating the CPI report. And so he still had a hawkish tone. And so I wouldn't be that excited, man, because maybe he's expecting some uptick on the inflationary side as well. And due to this report, you know, we saw stocks rally, but also we saw bond yields fall, which is what should happen. And people think we have reached a top in bond yields. We haven't. Going back to our Federal Reserve conversation, they're going to have to get rid of them. There's all that supply, and you got weakening demand. And we got more auctions coming up, which is exposing weakening auction demand, even from our foreign counterparts, or indirects is what they're called. And so I don't think the yields are done rising. And I think we may see another uptick in these inflationary numbers. Even if we don't, it'll stay relatively where it is. We won't see too many drops from here. And so that's my thesis on that. To kind of expound on what I was saying before. So if you look at this trueflation chart, and we referenced this chart maybe a month ago on one of our macro episodes, where we referenced trueflation, and you can see it at 2.9%. By the way, this has like a 99% correlation apparently. So it's extremely accurate. So if that is the case, we're at 2.9%, and that's not quite at the Fed's target, right? And so the inflation rate came out at 3.2, so it's not too far, or CPI, sorry. And so if the goal is 2.5%, which is going to take years to possibly get to, we're still not done. But also, since inflation is on a downtrend, it is a chance that the Fed is over tightening. They could overshoot, because as the inflation rate comes down and rates, the Fed funds rate stay the same, real rates go up. And so if real rates are going up, that means we're becoming more restrictive. And this is in addition to bond market action being restrictive within itself in terms of the Fed getting rid of those bonds. That's how much it affects, because that is another form of quantitative tightening. Because by getting rid of those bonds, they're pulling liquidity out of the system. That's how the Treasury refills their Treasury General account. And so, you know, are we at a point where we're at risk of over tightening? I would say so. I would say that we'll have a Fed-induced recession. If we have a recession, it's not because of natural forces, because the Fed has avoided those natural forces, I think. I think this will be a Fed-induced recession, 100%. And so we shall see. You know, it could be a scenario in which they over-tighten. It could be a scenario in which the bond market continues to tighten for the Fed, aka them tighten themselves by selling bonds, increasing supply. And so, yeah, it'll be interesting, man. So once again, it's easy to paint kind of whatever narrative you want to paint. So yeah, man, we shall see what happens. You got any thoughts on that?
I was gonna say they probably don't even have. There's no way for them to know when they're over tightening. They just gotta.
Yeah.
I know they got like their checks and balances and shit that they look at, but like seems like most of it is intuitive for them, huh?
Well, not intuitive, but kind of based on the data, trying to, I think, calculate the lagging effects. Because since monetary policy operates with a lag, you know, sometimes they may just get the timing wrong. And I think I've been saying this for quite a while now. Before they actually went on this pausing episode, I was making videos saying they're pausing because they just want to figure out what's going to happen. Because they, like you said, they don't know. And so we don't know if we've over tightened. We know that we had to get the interest rates above the inflation rate. Once we did that, that's when we paused, because inflation was coming down and interest rates were going up. And so once we got it above that number, the CPI number, that's when we basically went on this pausing episode. And now is the time of assessment. And with this CPI report, a lot of people think that, okay, the Fed's definitely done pausing based on this CPI report. I would actually agree, but not because the CPI report is good, but because they still have the balance sheet to take care of, which will do some damage within itself. And so that's why I think they're done hiking. because they know that they're carrying out QT or tightening monetary policy through the bond market. So
how long you think they'll keep rates this high for? So the data says otherwise.
Either until, I don't know. Let me say it like this: the only way that we'll start to cut rates, in my opinion, is if things start to go bad. But we won't go back to the zero bound. I can see us getting back down to 2.5%, 3% on the Fed funds rate to give us room to operate in bad times. You know what I mean? Because that's why we had to print so much money, because we went to the zero bound. And so we'll keep rates this high until something inevitably goes wrong. Now, at that point, let's say they decide to go the route of, instead of lowering interest rates, let's just print money through lending institutions and see if that spurs on economic growth, as opposed to adjusting interest rates. Or we could see them cut, it was UBS who came out and said today that they expect like a 270 basis point cut. That's 2.7% cut in the Fed funds rate. So if we're looking at a 2.5% cut from here, you're looking at, 2.5%, 3% on the Fed funds rate. Now, I think that's a more realistic number long term, for the reason I just described before. But it's hard for me to see them cutting in the next, let's say, 12 months, which a lot of people think they're going to get, unless we get something breaking. And then even at that point, it comes down to, do we want to print money in a way that, pushes it through institutional interest versus stimulus bills, because that's more quicker inflation. And by pumping liquidity through institutions, if it becomes inflationary, that's inflation that they have more control over. And so, even then it comes down to that. So yeah, we shall see. And they're in the same boat. I'll never forget the quote, man. It's kind of still crazy to me. Navigating by the stars under cloudy skies. Like, that's crazy to hear a Federal Reserve chairman say. But we're seeing that play out right now. He's up there like, get the ball on, get the ball on.
I got Will Durant books before he did the speech that day.
Will Durant, you said?
Yeah.
Probably. He probably should have been hanging out with like LeBron or something. He would have been a better liar. Like, oh yeah, things are good. Things are good in the economy.
I've been reading it. I'm not on the first page still.
But yeah, man, Will Durant, just because I'll end in my rant off here. Will Durant said it best, man. Childhood may be defined as the age of play. So therefore, some adults are never old and some children are never young.
That's deep.
Yeah. So yeah, I guess we'll wrap it up here then. If there's anything you guys want us to discuss in the comments, any data point that comes out, and we're pretty flexible, so it could be in pretty much any market. If it's like a commodities question, we can bring someone on to answer these questions. So yeah, let us know in the comments what you guys want to hear. Let us know if you like what we're releasing as of late, because we're going to keep at it, man. So let us know what you guys want to see. I appreciate you watching, because I feel like we've been getting some pretty consistent watchers of our last few episodes. So I appreciate that. Yeah,
definitely. I second that. And then, so our courses are officially on sale. Visit NoahDowside.xyz. We've been working on this thing for about 1.5 years now. So we're not just letting people buy. You have to book a free strategy session first. And, we have characteristics that we look for in a person that will determine if we feel it's a good fit for you. That's the most important thing, if it's a good fit, because we don't know if it is. Like I said, we're just rolling it out. So worst case, it's not a good fit. We'll be able to point you in the right direction, and we'll still keep the lines of communication open, as you never know what happens down the line. Best case, it's a fit for you. You get to go through the best course on yield farming and generating passive income in the world. And I can say that because I've went through all the courses. And yeah, we're just trying to build a group of like-minded people who have integrity, who are honest, who are hungry for knowledge, curious, passionate about crypto, and passionate about investing and moving the needle on their financial future. If that sounds like you, book a free strategy session on the website, and we look forward to meeting you. Other than that, we'll see y'all in the next episode.
See you on the next one.